2022, all the way since the pandemic and maybe even before, the market's been crazy. It is so hard to find a deal. And folks, I want everybody to realize one thing in real estate. The thing I've learned in the one commonality that I'll share with any other real estate investor is the money on any real estate deal is made on the buy. And if you can't buy it, at the right price, if you can't buy it with the right price, you can't make money. I learned that the hard way. Many of you are learning that the hard way right now because you're going the same place everybody else is. You're looking over here and everybody's buying off the MLS. So you're going there and you're getting outbid, or you maybe don't get outbid, but that means you overpaid. And then all of a sudden at the end of the day, you're relying on speculation of the market price to continue to go up. And some people literally are, I go on these Facebook groups and some of these people just think like the roaring 20s, it's going to the moon. They think because the government printed $5 trillion that this real estate thing is never going to end. And I hear it all the time. Yeah, but there's so much demand. I said there's so much demand because they printed $5 trillion. There's so much demand because rates are close to zero. Well, the Fed just announced they're going to raise rates up to 7 times this year. Now they said maybe not 7 because of the Russia-Ukraine war. Who knows? Every day that changes, it's insane.
That's right.
And, they're going to raise rates. They're going to slow down the bond purchase programs. They're going to unwind the balance sheet, which is going to suck liquidity out of the markets. And people still literally think that this real estate market's going to keep going up in price. I call their fault.
Well, I think you already have seen that in the Dow Jones in the market. When we hit the first of the year, you started to see a sell-off. And I think some of that was tax driven to go get me out of the calendar year 21, get it into 22, let's sell off. And now we're quickly approaching, a technical correction in the marketplace. And why do I draw, it's not always a direct parallel, but I'm drawing this to point to that because they're faster to react there. Real estate's slower to react. All right. The illiquidity in the market has it forced to react in a much slower fashion. But you've already seen that there's significant doubt and uncertainty as expressed in where the market's trading.
100%. And I think through all my academic studies and, when I was in Wall Street, one of the things we were always taught is, we were talking about correlated asset classes. How does real estate correlate to the stock market, and what's a lagging indicator and so on and so forth. But real estate is a lagging indicator. And all that means, just to get the simplest thing we can say, is if the stock market sells off like it is right now, we are very close to literally a reversal or a correction territory, which means at that point, it's very unlikely that the markets will continue to bounce and go back up. They will continue to slide to the next level. And this will be what I've been talking about for far too long, like a broken record, the next big recession or depression. But nonetheless, real estate is a different animal with one exception, which was 2008. Real estate lags the overall stock market. So if the overall stock market drops, it doesn't mean that real estate drops immediately. And we saw this in the dot-com crash. Real estate didn't go right down when the market went down. It took 6 to 8 months for real estate to even start showing signs of a decline. And I think you're very much going to see that, even though I truly feel that real estate is in a very crazy cyclical bubble, one that not because of, improper dealings with banks, but partly due to that, but more so because of cheap money and monetary, printing of money. I think you're still going to see a pretty heavy decline in real estate prices in certain parts of the country. Maybe not all. I think Texas, Florida might be somewhat insulated because of some political reasons. But outside of that, I really feel like this speculation that people are really hoping continues. Once the market slides and goes past this correction territory, I really think you've got a ticker started. Like, you might as well set that stopwatch for 6 to 8 months and you will start to see real estate start to decline in that. So Neil, with what you're doing, I want to kind of know what you're thinking about this. And then I also, because listen, there's always two sides to every story. I could be wrong. I hope I am. But I want to know what your thoughts are. But then I also want to know with what you're doing, because you're using $5 to $10 million of private money in your fix and flip. So if you're if you're not thinking about what's coming, boy, that'd be a scary proposition to use that much money and to be partnering with people and funding their deals. So that was long-winded, but what are your thoughts?
Yeah, no. So let me address that in two parts. One, where do I think we're headed, globally from a real estate standpoint? And then two, what do we do and how are we partnering with folks? I agree with what you just said. I think this slide has taken place since we came off the gold standard. I think that was probably the line in the sand to go. We now have a monetary policy that is made up largely, right? We don't have, it's not a real asset. It's not backed by anything, just the good faith of the government. And we're at a point where we've continued to borrow. I think our nation has a tremendous debt crisis. We've continued to make it worse and worse by continuing to print money. And the day is coming where we are going to have to pay this back. So that means, our options to pay it back largely means continued GDP growth and a significant increase in taxes, or we inflate our way out of this. And I suspect that inflate our way out of it because becomes an easier way to point blame, when you're running for an election versus let's raise taxes, and not just a little. I'm talking a lot to get our way out of this.
Holy crap, man. Those are some really wise words put in a very short way. I hope everybody listening just heard that. He basically explained the ways that the government can get out of this debt. And many people would say it's physically impossible, but it's not, because the government can drive inflation very easily by using modern monetary theory, which is an economic theory that will eventually destroy the United States of America for what it is today. But put that aside, it prints money, which then infuses money into the capital markets with exchanging debt with the Fed, for money that they give to you and in the form of EDIL, stimulus checks, and PPP loans, and so on. You saw all this happen just a short while ago. Then the market goes up in bubbles like this, and it makes everything looks good. It's really good for votes for the politician that's in office. Everything seems great. But when the printing press can't print any more money, an example like the infrastructure deal. So they went through their first phase. You can only push, all these different, two-sided stories so far before they have to find the next story. The infrastructure deal was a legitimate effort by them, but it didn't make it. So that was $3 trillion plus that they couldn't print. So now they're sitting there saying, great, how are we going to print more money? Well, look at the history books, folks. I'll tell you exactly how they're going to do it. War. I said it. And you know what? You can hate me for saying that, but history proves that is absolutely what the next lever will be. The government will somehow, some way find a way for us to make it into this war, which will, I hate to say it, but it just seems too much like World Wars I and II on how we're entering this. I mean, we really shouldn't be as concerned about this whole thing, but we certainly seem to be really concerned and eager to get involved in this whole Russia-Ukraine thing. But that would give the Fed, who has funded, if you look at it, the capital banks have funded every war back since the Fed was created in 1913. So why not do a war? Because then you have a reason to turn the printing press on. You have a reason to make it seem like we're doing all the right things, and that drives votes. But that also drives inflation. And as inflation goes up, inflation, everybody thinks, is that gas gets more expensive and food gets more expensive. You're wrong. Inflation is a hidden tax. All inflation means, and if you study Germany, you'll know what this is, your dollar that you work very hard for, this thing, gets weaker. They print more. Every time they print a dollar, your dollar becomes worth less and less and less. So think about it this way. Let's just say you owed Visa $50,000. And Visa charged you 29.9% interest on that. That would suck, wouldn't it? But then let's just say through a turn of events and some things that you can't do, but let's just pretend you could, you were able to pay Visa back at 50 cents on the dollar. And it wouldn't affect your credit. It wouldn't hurt you at all. You literally just get to say, hey, I owed you 50, but now I'm only have to pay you back 25. You'd be psyched, wouldn't you? Well, that's exactly what inflation is for the government. It gives them the ability to pay back all this debt at pennies on the dollar. There. That's what inflation really is. So if you think the government and the Fed really cares anything about slowing inflation down, that is a hidden agenda. They need to raise interest rates because they know that the next fall of the market is coming. And the first lever they have to pull to stimulate an economy, the interest rate lever, every single time. So if interest rates are close to zero like they are now, they don't have much to pull. So they got to jack them up quick, maybe 7 times 2022, so that then they can pull them again when the market collapses and they all seem like heroes. Neil, I didn't mean to take your time for that, but it was just a smart thing that you just said there. And a lot of people don't fully understand that. So given that,
I couldn't agree with you more. So let's talk about, how to one protect themselves in my opinion. in that position. And then I want to talk about what it is that I do from a partnership standpoint. So how does one protect themselves? I mean, you need real assets. And so from our standpoint, it has been to acquire commercial or apartments, bigger properties, and put as much long-term fixed rate debt on it as you can possibly get. Because, the apartments are probably a little better spot than some of the commercial pieces. Some of the commercial pieces where you end up in a 5 or 10 year lease, you know exactly where you're going to get paid 9 years from now. The apartments have a little more variation with them because you've got typically a lease that resets every year. You've got the ability to make a decision. Do I increase the rate? Do I lower the rate? Do I keep it the same? So you get a chance to make a decision there. And I think that's probably the best protection one can be putting in place today from a real estate solution standpoint. Long-term fixed rate debt is how you hedge against inflation. Because at the end of the day, your property would be worth a lot more if your rents can keep up with that, whatever inflation happens to be.
Great. So when you're buying properties, just so that, because we're going to have a lot of people listening, people that maybe own 1 or 2 properties to some people that have 0. They might hear that and say, okay, so the thing to do is just go out and buy real estate and rent it out. But you probably have a formula when you run the numbers for the property, because it has to pencil or it has to make financial sense. Are you building in some metrics to account for maybe even a slight pullback in these rents and making sure that your properties are sustainable into the foreseeable future?
Yeah, it's a good question. Yes, you want to have an understanding when you're putting this in there is, I've seen a lot of, you touched on it. Everybody thinks it's the roaring 20s. I've seen a lot of decks come out, raising capital, thinking, when their estimates have 5, 6, 7% rental rate increases per year for the next 3-4 years. And I'm going, this is crazy. To think what has always happened and will always happen is nuts. At some point, we're going to revert to a historical mean. So why not be budging that, putting that in, and running the calculations based on what's average, what's historically average, and what's historically below average. You want to stress test the deal to know what do I have to be at from an occupancy standpoint, from a rent rate standpoint to break even.